Have you ever wondered how credit works in the USA? In essence, credit is a system that plays a significant part in our financial lives. It's like a trust-based agreement where you get to borrow money or access goods and services now with a promise to repay later. Think about it. When you're buying a home, a car, or even financing education, you're using credit. It's not just about borrowing money, it's about your financial credibility, your reliability. Businesses, too, use credit to expand operations, purchase inventory, and manage cash flows. Credit is not just a number, it's a reflection of your financial history and behavior. It's a testament to your financial responsibility and discipline. It's a tool that, when used wisely, can open doors to various opportunities and financial freedom. Now that we understand what credit is, let's delve into the entities that monitor credit activities. So, who keeps track of all these credit activities? Well, in the United States, there are three major credit reporting agencies tasked with this role: Experian, Equifax, and TransUnion. Like diligent librarians, they compile vast amounts of credit information from lenders, creditors, and public records. Experian, based in Ireland, is a global leader in consumer and business credit reporting. Equifax, with its roots in Atlanta, is one of the oldest credit agencies, tracing back to the early 20th century. And TransUnion, the youngest of the trio, operates from Chicago, offering a range of credit and information management services. Each of these agencies collects data about your credit activities, such as loan payments, credit card usage, and any outstanding debts. Using this information, they generate credit reports, which are essentially comprehensive records of your credit history. These agencies play a crucial role in determining your credit score. But what exactly is a credit score? Ever heard of the term credit score and wondered what it means? A credit score, in its simplest form, is a three-digit number that represents your credit worthiness. You can think of it as a financial report card, with the grades ranging from 300 to 850. The higher the score, the better your credit health. Why is it important, you ask? Well, lenders use your credit score to evaluate the likelihood that you'll repay your loans on time. A higher credit score can lead to better interest rates and more favorable terms on loans and credit cards. So how is this score calculated? Factors like your payment history, amount of debt, length of credit history, types of credit, and recent credit inquiries all play a part in determining your credit score. But remember, your credit score isn't set in stone. It's a dynamic number that changes as your financial behaviors evolve. Credit scores are derived from your credit report, which brings us to our next topic. What information does a credit report contain? Great question. A credit report is like a financial report card, and it carries vital information about your credit history. It's compiled by credit reporting agencies, and it's the document that lenders look at when deciding whether to approve your credit application or not. So what's in this report? Your credit report contains your personal information, including your name, address, and social security number. It also outlines your credit accounts, detailing when each account was opened, the type of account it is, your credit limit or loan amount, account balance, and payment history. Also included in your credit report are records of debt collections and public records related to your credit, such as bankruptcies or tax liens. Lastly, it shows all credit inquiries made about you. This information helps lenders assess your credit worthiness, essentially answering the question, how likely is this person to repay borrowed money? Your credit report is influenced by the type of credit you have. Did you know there are different types of credit? Yes, indeed, there's more to credit than just plastic cards. Let's break it down. First, we have revolving credit, a flexible form where you borrow against a set amount, but only pay interest on what you use. It's like a reservoir of funds you tap into when needed, with credit cards being a prime example. Next up is installment credit. This is your traditional loan format, where you borrow a lump sum and pay it back in regular installments, typically monthly. Think mortgages, car loans, and student loans. Lastly, there's open credit, a bit of a hybrid. It's a pre-approved loan that doesn't have a fixed end date or regular payments. Charge cards often fall into this category. Each type of credit serves different purposes and offers unique advantages. Understanding them can help you make informed financial decisions. Having a mix of these credit types can help build your credit. How can you build a strong credit history? Let's dive right into it. Building credit is like constructing a house. You need a strong foundation for the structure to stand tall. And it's the same with your credit history. The first brick to lay is making timely payments. When you consistently pay your bills on time, you're showing creditors that you're reliable. And that's exactly what they want to see. The next step is to keep your balances low. This is known as your credit utilization ratio, which is the amount of credit you're using compared to the total credit available to you. A lower ratio typically leads to a higher credit score. Finally, avoid applying for new credit too often. Each time you apply, a hard inquiry is made, which can temporarily lower your credit score. Remember, building credit is a marathon, not a sprint. It takes time and patience, but the advantages are worth it. One common tool for building credit is the credit card. How do credit cards affect your credit? This is a question that often pops up when discussing credit. Credit cards, when used responsibly, can be a powerful tool to build your credit history. Every time you make a payment on time, it's like a pat on the back for your credit score. However, it's not just about paying on time, it's about how much of your available credit you're using. This is called credit utilization, and ideally, you want to keep it below 30%. If you max out your credit cards, it could negatively impact your credit score, even if you pay on time. But credit cards aren't all sunshine and rainbows. They can be a slippery slope into debt if not managed properly. High interest rates and the ease of spending can lead to a cycle of debt that's hard to break free from. That's why it's important to use credit cards wisely. Pay your bills on time, keep your balances low, and always read the fine print. It's important to monitor your credit regularly and dispute any errors. What if you find an error in your credit report? Imagine you're scanning your credit report and spot an unfamiliar account or a payment marked late when you know you paid on time. It's not an uncommon scenario. Errors can occur for various reasons, from simple clerical mistakes to identity theft. So what should you do? First, don't panic. Federal law grants you the right to dispute inaccuracies. You'll need to contact the credit reporting agency and the organization that provided the information. Make sure to send a written dispute letter, clearly identifying each error, why you believe it's wrong, and request a correction. The credit reporting agency must investigate your dispute within 30 days. If they find your dispute valid, they're required to correct it. If not, you can request to include your statement of dispute in your credit file. Regular credit monitoring can help you catch and dispute errors early. So stay vigilant and maintain your credit health with diligence. How can you keep an eye on your credit? By actively participating in credit monitoring. This is the process of reviewing your credit reports and scores for any changes that may indicate fraudulent activity. Just as a doctor checks vital signs to monitor your health, you need to check your credit status to maintain your financial health. It's about keeping your credit pulse in check, ensuring it's strong and steady. There are several tools available for credit monitoring. Some are free, like annual credit report checks, while others require a subscription fee. These tools not only provide regular updates on your credit score, but also alert you to potential fraud or identity theft. They can spot unfamiliar credit inquiries, new account openings, or significant changes in your credit balances. These monitoring services are like your personal financial bodyguards, watching over your credit round the clock. They offer an extra layer of protection and peace of mind in a world where digital threats are constantly evolving. Remember, credit is a tool. Use it wisely and understand the laws that govern it. What laws protect you as a credit consumer? Well, in the United States, several laws safeguard your rights. Let's start with the Fair Credit Reporting Act, or FCRA. This law regulates the collection, dissemination, and use of consumer information, including consumer credit information. Under the FCRA, you have the right to access your credit information and dispute inaccuracies. Next, we have the Equal Credit Opportunity Act, or ECOA. This law prohibits credit discrimination on the basis of race, color, religion, national origin, sex, marital status, age, or because you receive public assistance. It ensures that everyone has an equal chance to obtain credit. These are just a couple of examples. There are other credit laws like the Fair Credit Billing Act and the Fair Debt Collection Practices Act, which protect you from unfair billing and collection practices. Understanding these laws can help protect your rights as a credit consumer in the USA, so take some time to familiarize yourself